I can make anyone a profitable stock trader. Over the next 20 minutes, I'm going to teach you how to navigate the market with laser precision. These are the same techniques used by some of the greatest traders who've ever lived. My name is Ross Givens, a 20-year veteran of the financial markets and a former vice president of investment management with JP Morgan Chase. I've coached tens of thousands of traders and investors, and today I'm going to distill 20 years of market knowledge into about 20 minutes. You'll learn what stocks to focus on, the signs of a potential big winner, and precisely where to buy and sell. You'll learn how to keep risk small while maximizing gains on the strong moves higher. Best of all, you don't need any financial experience to do this. You don't need a degree in finance, securities license, or 10,000 hours behind the screen. If you can work a computer and pass third grade math, you can do this. And I'm going to show you how right now. Let's dive in. So the first thing you need to know is where to buy. Your job is to enter a stock at a precise moment where it has a high likelihood of delivering a big and fast gain. I'm not interested in buying stocks that bounce around for 6 months before they go somewhere. I just want that quick burst, that 30, 50, 80+% in that kind of 2 weeks to 2 months range, and then get out to go for the next one. This is something known as swing trading. Now, what you're looking at here is a daily chart of Kenross Gold, ticker KGC. I've marked up the pattern. I'm going to walk you through and put an arrow on the points you should have bought. And right there, getting in at the $16 mark, you can see the stock quickly rose to just over $26 in about 8 weeks. So what is happening here? Well, you need to understand what moves stock prices, and this is paramount to building a foundation as a stock trader. And it is not you and me that move stock prices. It's not retail investors. It's not mom and pops with 401ks. It is big, large, multi-billion-dollar institutional funds. That's Warren Buffett. That's Goldman Sachs. That's the Notre Dame Endowment Fund, the New York City Pension Fund, large ETFs, hedge funds. These are the ones that move prices simply because they're buying so much more. And if you're buying billions of dollars worth of a stock, two things. One, it's going to take a month, 2 months, 3 months to build up that position because you're trying to buy so much without shooting the stock up. And secondly, when you do so, when these institutions do so, they leave a footprint on the chart, and it looks like this. So let's kind of walk through this here, what's going on, all right? So the first thing you're going to see is a big rise in the stock. In this case, it went about 50% right here in just over a month. And again, this is a telltale sign that big institutions are buying. This is a $29 billion company, okay? So it added, what is that? $10 billion worth of market cap. And the only way that can happen is if big, large Wall Street buyers are getting in. All right. So the stock's made a big move. It is in play. You have some proof there's demand for the stock. And what you want to do next is allow this thing to play out, absorb the supply, and get ready for another run higher. So we'll kind of use the magic of tools here to kind of go back in time, and let's just look at this. So one, the stock goes again about 10 to 15. Now, it's a big move. You're up 40, 50, 60% in a month or so. A lot of people are going to want to take profits. They're going to sell. You might be one of them. And so when you're holding a stock that's made a big move, some people are going to sell, and that's going to push the stock down. So if they're still building a position in the stock, or if there's still big demand for it, you'll see traders take advantage of this dip and buy it back up. It then pulls back again, drive it back up, pulls back, driven up, pulls back up. And as this is happening, what you're seeing form on the chart is this shallowing pattern that I've drawn below there in white. And this is really a crucial part of this, because what's happening in this period right here, in this area, what's happening is the supply is being absorbed from that stock. Okay, the stock market, every stock trades on the basic principles of supply and demand. The reasons for the supply and the demand, yes, there's earnings. Yes, there's macroeconomic things. Yes, all that. But we got to strip it down. If there's more buyers than sellers, it is going to go up. If there are more sellers than buyers, it is going to go down. And since we know the big guys are buying tens of millions of shares at a time versus us buying a couple hundred or a couple thousand at a time, whatever they are doing is going to dictate the movement of that stock. If they're all buying, it's going to go up. I don't care what it is. I don't care what the story, the earnings. If Wall Street shops are all buying, it's going to go up. And when they all decide to sell, it is going to go down. Period. Hard stop. So get it out of your head that you're trying to outsmart Wall Street, that you can forecast better. Even if you can, you're going to be wrong because of the sheer size of their buying and selling. So what's happening here is they're buying the stock, they're buying it at $9 and $10, $11, $12, and eventually it starts to get high. And so there's profit taking, meaning people wanting to just sell and get out with their nice win. They're also going to play a part in trying to bring this stock down. And while this is not always the case, it is much more common than you think. They may have analysts downgrade the stock to try to spook investors. They may float stories in the financial press about why this company's in trouble or the industry's in trouble or the market's in trouble. And all they're trying to do is scare, shake, and bore people out of this stock so that they can buy it up. Remember the thing, if there's more demand and supply, it's going to go up. They have huge demand, but there's not enough supply. There's not enough shares currently offered for sale for them to buy as much as they want. So they need to kind of create that supply. And so they'll use the media. They'll use big spoofing orders at the open to send the market down in times of low liquidity. They'll have analysts downgraded. They'll do all this stuff to try to push it down. But meanwhile, as they're doing that, they are taking advantage and buying it up. They're gobbling up the shares. They are absorbing all of this supply. And once they've gobbled up as much stock as they can in that $14, $15, $16 range, once there's no more shares being offered in that price, at least not at scale, then if they want to buy more, they got to pay up. Would you take 16? Would you take 18, 20, 22, $24? That's what allows the stock to make the big and fast runs. It's not that demand necessarily increased. And if you look down there at the bottom of the volume chart, you'll notice that the trading volume, how many shares traded in this kind of 1 month period versus the months before, was not any bigger. It's not as if everyone suddenly came out buying the stock. The demand is roughly the same, but it's chasing a smaller pool of supply. This is why we want to use this breakout pattern. We are letting the big Wall Street shops show their hand. That's going to be the big rise. And then we let them absorb the supply. They're trying to quietly buy. They're not telling anybody, but they leave a footprint, and it's the shallowing pattern. And the reason it shallows, and when I say shallows, I just mean that these pullbacks get smaller. So this is about a 17% drop. Next time, it only drops about 8%. Next one, again, is kind of in that 7 to 8% range. And it gets even tighter. Then it's down here at like 5%. This last pullback here was only about 4%. And the reason it's shallowing and tightening up, when I say tightening, again, I just mean it's kind of wedging forward, the pullback's getting shallower, is that there's less and less stock available to buy. And the other nice thing about this is you don't need to risk a lot of money on this. And that's the other part of the trading equation. It's not just how often are you right versus how often are you wrong. It's how much do you make when you're right and how much do you lose when you're wrong. This is known as your risk-reward ratio. What are you trying to get for every dollar you're risking? And my goal is to make 2, 3, 4 times what I'm risking on a trade on average, all right? So if I'm risking 10%, I'm targeting 30 or 40. If I'm risking 5, I can target 15 or 20. And you must be cognizant of this, because where I see a lot of people get in trouble is like these big risks. They're risking 30, 40, 50% on these stocks. Then they go up 15% and they sell them. It's like, you're going to be out of business very quickly. And so here's how we handle the risk equation. Now, again, the shallowing component of this is really important. We need to see volatility decreasing, the price action tightening. And since this tends to shallow, so let's see what happens. It puts this low in here in early May at about 13 and a quarter. All right. Now, again, this thing should tighten. If they're wiping out sellers, if they're absorbing supply, when it comes up, it should not come down here again. So if you're to buy a breakout, that's where you'd want your stop loss to be. But then it comes and tightens up again. Comes in, breaks down here. So then at that point, the stop loss will be this swing low. Notice it runs up, pulls back, again, stops right in there, comes up, and now it's lower. So then I would bring this up in here. It runs up, tried to break out, pulls back a little, comes back. Now I'd bring my stop loss up to here. And so when this thing finally breaks out and you buy it here, call it $16.5, $17, your stop loss, and this is an automated order you place. Just put a sell stop order. It will trigger it to sell at the market automatically if it falls at this price. And that's going to represent your risk. So if I'm buying here at about 16.5, my stop loss is here at 15, call it 15.40. My total risk on this trade is 6.79%. So if I am wrong, the breakout fails, it rolls over and starts going lower, I'm only going to take a 6.79% hit. I'm not going to be out on the street with a cup in my hand. I'm not going to wipe out a quarter or half my account. I'm taking very, very small risks. And that's how we get that high risk reward ratio. Now, you might look at this chart and say, well, Ross, you're kind of cheating there. Wouldn't you have bought this breakout in there? And actually, probably yes. I probably would have got it there, that initial pop higher. So how that would have played out? Well, my stop loss would have been right here beneath that swing low. My total risk would have been 7%. It goes up, begins to pull back, never hits my stop loss, and then propels higher, shooting to 19, 20, 22, 25, and beyond. All right, so it's that combination of very precise entries, identifying these spots where the supply and demand dynamics are working in your favor. You have an edge. There is a good reason it should shoot up very quickly, and that reason is there's no much supply, right? It's very simple. If you think about, if you got $10 in a room and 10 widgets, so 10 people with $1 each, 10 of them with one widget each, and it's a market they're trying to sell, they're all going to sell for $1 a piece, right? If suddenly you took 8 of those widgets and threw it out, so then you had $10 chasing 2 widgets, well, people they're going to kind of team up. Well, I'll give you 2 for it. I'll give you $3, 4, right? There's more demand than there is supply. And that's the same concept we're doing here. It's simply in hundreds of thousands or millions of shares. But every share of a stock is not available all the time. A lot of these are sitting in 401k accounts. They're in ETFs. Somebody bought it. They're holding this thing for 5, 10, 20 years. The supply we're talking about is what's known as the float, the number of shares being actively traded in the market available to buy. And when that shrinks, then the same amount of demand can propel the stock much higher, much quicker. And then we're coupling this with stocks that are showing they are in great demand. They're rising. They're making these big outsized gains and then consolidating, building up a pattern that will allow us to exploit them. So how do we know where to focus? Ross, there's 8,000 stocks out there. What am I going to do? Go through all of them? No, I got a trick for you. You just want to focus on where the strength is. Now, remember we talked about at the beginning, institutions are the one moving stock prices. So whether it's ETFs or mutual funds or endowment funds or pensions, whatever they're buying is going to go up. And these guys tend to invest thematically. And what that means is they're taking a big macro picture and they're saying, here's what we think the big opportunity is for 2026 or 2027 or whatever going forward, all right? And so that maybe their focus right now is nuclear energy. They're saying, hey, these AI data centers need a ton of power. The traditional electricity grid can't handle it. There needs to be a clean energy solution. Nuclear makes a lot of sense. The administration is cutting a lot of the red tape. We've seen some big breakthroughs with nuclear technology. We think this is going to be a huge opportunity. We want to focus on nuclear. And when they do that, they're going to go buy all the nuclear stocks. They're going to buy OKLO and SMR and GE Vernova. They're going to build the companies that make the components and the software for these facilities and the whole space. And so when they do that, if they're all buying a particular area of the market, that area, that sector or subsector is going to rise faster than the others. And so your job as an active investor is to keep abreast of this, to see where the strength is and laser focus just on those 2, 3, or 4 areas. Because there's 60, 70, 80 different subsectors of the market. We're going to focus in on 2 or 3. We're going to look at the top 10 to 20 stocks in each of those, and we're going to take a universe of 8,000 publicly traded companies and whittle that down to just the 30 or 40 we want to look at. And it's those we're looking for this pattern. So here's how you do that. Now, this is the ugly way. What I've put up here is a chart of the S&P index, and then I've added 40 other line charts, each representing a particular industry or sector. And so where that came from was this list I'll show you here on the screen. It's using publicly traded ETFs that represent certain areas of the market. So ITA is the aerospace and defense. DBA is agriculture. XPE is banking. And each one of these exchange-traded funds holds a basket of stocks in that particular area. So there is a nuclear ETF, ticker URA. In that stock is all those nuclear companies, it's uranium miners, it's all those names we mentioned. And so what we can do is look at this over a 1-month period, a 3-month period, a 6-month period, and look at which areas are rising the most. Over the last 6 months, what do we have here at the top of the list? XME. All right, XME is the metals and mining ETF. That's all the big mining companies. You can see the breakout here. Now, this is obviously kind of a pain. I can show you how to put all these in and do it, but I'm also going to give you a shortcut. And what we did was code this little, I call it an indicator. It's really not an indicator. It's just a table. But it takes all these 40 sector ETFs and tracks the price performance over the last 1 and 2 and 3 and 6 month periods. And we can very quickly see which areas are rising the fastest. Now, it's late November 2025 right now. It's at a small dip in the market. You can see as of today which areas are leading. Look up here at the list. The top performing sector out of 40 in the entire market over the last 1 month is biotechnology. Number 2 is pharmaceuticals, pretty much the same thing. Over 2 months, biotech, pharmaceuticals. Over 3 months, biotech, pharmaceuticals. Over 6 months, biotech. So the market is showing you where the dollars are flowing, where the hot areas are. So I'm going to laser focus on pharmaceuticals and biotechnology, maybe lithium stocks, since that one's really strong there. Now, by the way, we give this indicator, this industry strength indicator, away for free to all of our members. We have a YouTube special. It's $5 for an entire year. If you click the link below this video, you can sign up for that. We'll give you access to this industry strength indicator we've made. And along with that, you're going to get live mentoring sessions every Monday for an hour with me. They're live members-only session with our analyst, Jean, on Thursdays, in addition to stock tips, my weekly video, and a ton other. It's $5, absolute no-brainer. Click that link. You can have all this. And what we're doing here is essentially fishing from a stocked pond. We're saying, okay, here's the areas that the big shops are buying. They've got momentum. They have the wind at their back. The big demand from the big players is coming into these. We're then looking at the top 10, 15 stocks in each one of those groups. And then we're looking for this breakout pattern that allows us to get in at a precise moment where we should see a big and fast gain. And we're doing all of this with usually a 6, 8, maybe 10% risk. And this has been the secret formula that we've used to deliver outsized gains. And we can go back in time here, all right? So let's just go back and you'll see how this works. So nice thing about TradingView, it's got this little replay features. Let's just go back here. Well, let's take it like right up in here. Okay, this is we had the market sell off during the tariff situation. It started to recover really quickly. So you're right in here. You're like, all right, what do I buy? The market's coming back. It's ripping up higher. Where do I focus? What stock should I look at? All right, perfect. Let's go see. So let's just go back here to early May. All right, and at that time, the leading groups were what? Nuclear. Over the last 1 month, nuclear and uranium. 2 months, nuclear and uranium. They hadn't begun to rise up the older ranks here, but coming out of the gate during this super strong month of the market, early stages of recovery, nuclear, crypto, that was clear as day the place you wanted to focus. And you can quickly build a list. I've got a video on that as well, I think, on how to build a stock watch list, but all of this is public information. All right, so if you just pull up a page, let's say you see this. I want to focus on nuclear. Great. What are the stocks? Well, you could Google top nuclear stocks, but here's an easier way. Nuclear ETF. iShares Thermatic. There's several you can pick in here. The Global X Uranium. But any one of these, they have to disclose their holdings. And so all you got to do is scroll down on one of these, and it will reveal all the stocks they're holding to build a basket of the top nuclear stocks. So CEG, Constellation, CCJ, Cameco, OKLO, Centrus Energy, right? All these stocks. And then just put those in a watch list and look for this pattern. And let's just do that. This is OKLO. Again, I want to do this back to that May 2nd date. So let's bring this back in time here. And this is what was forming at that given time. And so, okay, I need to focus on nuclear. This thing looks like it's setting up. It's tightening, it's tightening, it's tightening, it's tightening. It's getting ready to break out. And you buy as soon as it does. And what you've done here is buy one of the top stocks in the nuclear space. Nuclear is the leading group in the market. You're buying it coming out of a clean breakout pattern. So you've got a top stock in the top area with a really clean pattern. You're doing this. Your stop loss is just here beneath these little swing lows. So you're risking, this one's a bit more volatile. So it's about 11 to 12%. But then look what happens. It just soars. That 11 to 12% risk very quickly turns into a 140% gain. And this is over a 7-week period. And so it's going to do this now. Now it's made a big move again. What you want to do if you're trying to buy more is wait to see this pattern form again. Wait for the consolidation when you have an edge. And look how it does that. Big move here, tightens up, tightens up, tightens up, breaks through, stop loss at a swing low. And once again, you've got this big quick gain. I mean, this is a 70% move in just 10 days. So it's just top to bottom. You want to be in a bull market or a quickly recovering market. You want to laser focus on these areas showing the most strength. You want to focus on the top 10, 15, maybe 20 stocks in that group that are all being bought. And you want to do so at a time where the supply and demand dynamics give you an edge and you can have a reasonable expectation of an above average gain in a short amount of time without taking a lot of risk. Now, the areas seeing the most strength will change a bit month to month. Usually there's like one big overarching theme driving a bull market. This one has clearly been AI, and yes, NVIDIA and Supermicro and a bunch of those made huge moves, but now that it's spread out, here is going into nuclear and crypto and some of the others. And if we go forward another month, look at this. It was pretty clearly crypto here by the next month in June. Nuclear is still strong. It's at the top of the 1 month, the 2 month, the 3 month charts, but we have a new contester in it. We've got crypto in the number 2 spot, crypto in number 2, crypto in number 3, right? So it is rising up the ranks. It's moving faster than other areas. And so all we'd be doing is going in and looking at those crypto stocks in June. So this is one of those crypto mining stocks, Cipher Mining, CIFR. As you can see, you kind of have like a pattern within a pattern here. So big picture, you had this massive shallowing, tightening pattern. You see that it stalled here in that kind of $7 area, $7, $7, finally gets through. When it does, it rockets higher very, very quickly. But you even could have got in earlier. Notice I've got another line drawn down there below because within that, you also had this little move. Right in there, beautiful little consolidation, tightening. You buy right in there, and it makes you're rewarded instantly. Like that's 50% in 10 days. It comes back, retest right to your breakout area, almost exactly. Pushes back, stalls at the high, and then just rips. So if you bought here on the first little breakout, you've been up 50% in a couple of days. It comes back and retests. You're then up 180% in under 3 months. If you want to wait for all this noise, let it get out of the big zone here, that's fine. You buy in here, you're up 80% in 27 days. So there's obviously more to this. And like I said, I've done a video on when to sell because these high growth names, these stocks that are going up 80, 100, 200, 300% in a couple of weeks or a couple of months, heads up, they cut both ways. I'm not trying to find stocks I can hold for 2, 3, 4 years. I'm just trying to get in right there. It's exploding out, get out while the getting's good. And I'll gladly pocket a nice little 60% gain in 3 weeks, go back to cash and look for another opportunity. This is my go-to trading setup. Find good bull markets, identify the leading areas within that market, laser focus on the top 10 to 20 stocks in each of those areas, and then look for these shallowing base breakout patterns where I can achieve a big and fast gain very quickly, all while keeping risk generally in that sub 10% range. Now, if you enjoyed this content, do me a favor, hit the subscribe button down there in the corner. That way these videos will populate your YouTube feed. And if you haven't already, click that link below or go to tradewithross.com to sign up for our Black Ops trading service. It's just $5 for an entire year, no strings. I promise it'll be the most value you get this year.